Let me first ask you about the rate story that seems to be so front and center today. Bill Gross coming out and saying we could be in a bear market for bonds. He said it before, but now we're looking at more than 2.5% on the 10-year. Bunds are up to 55 basis points as well. Do you see this globally as a trend?
Frankly, the short answer is no. I would not be of the opinion that due to some technicals, and the backdrop for growth is good, but there are some technicals in the last hours and days who led to the situation that yields have risen. A little bit of news about different yield curve control, maybe in Japan, but still within the range they told us. In Germany, there's a special situation. We have a new benchmark 10-year bond, so the rise of yields is also due to the change in the benchmark bond. Overall, I think we only would be able to really call a bond bear market if the inflation picture really changes. And this we don't view. We see inflation staying benign, rising only moderately.
And so with the ECB, with regards to the ECB here in Europe, do you expect them then to back out of the quantitative easing that they've extended to September when they're done, or will Mario Draghi hold his foot on the gas pedal since inflation just isn't coming up to the 2% target that he's aiming for?
I think the ECB under the regime of Mario Draghi will be very expansionary and staying on the gas, as you said, for a very long time. So first, I think we should believe in his forward guidance, which is very strong, when he says that well past the end of purchases of bonds, rates will stay low. And given all the structural disinflationary forces or low inflation forces in Europe and the geopolitical hurdles we may face, I think that we see well into next year no change in rates in the Eurozone.